The US president took to Twitter to make it clear that he's unhappy with the pace of talks being held with China and in turn threatened to hike tariff on Chinese imports into the US, and that's left investors worried, with all equity markets trading with cuts of at least 1% or more. Joining us now to talk about the situation in greater detail is Seth Freeman, Senior Managing Director at GlassRatner Advisory. Seth, thanks very much for taking out the time. This is just, one tweet that the president has put out that has done this to global equity markets. What, according to you, if at all, he's put out the day of Friday, we do see these $200 billion worth of imports from China getting a tariff hike of about 25%. What could be the full-blown implication of that?
Well, I think we're seeing the implication and how it can royal markets and futures looking, U.S. stock futures looking down for tomorrow morning. For us here, we're looking at the impact on currencies. It's somewhat confusing to make these threats now when there was a meeting coming in Washington very shortly. And, perhaps he feels very buoyant and confident after seeing such strong economic news here in the United States that he feels a little bit more emboldened to, add some risk to the economy with these kinds of threats.
What does this do now to the overall, growth numbers and the projections that have been made with regards to global growth? We know that the most recent China economic data, or the GDP numbers, wasn't a bad number. We saw the markets take that well. But do you see, repercussions of this having a deeper seated impact on the overall growth?
Well, the so-called trade war was partly blamed for what looks like a trend of slower growth, globally, both the United States and other countries and China. The issue is that China is a strong country now, and it has the means to retaliate against the U.S. for added tariffs. China just recently put back in quite a large amount of additional soybean imports, which is very important to the United States agricultural economy. And so China has plenty of tools to respond. And, they also have internal political concerns as well in dealing with these tariff issues and the need to appear to be strong domestically, which, according to the news reports, might mean canceling the summit.
Yeah, I think that's come out. Seth, a couple of pointed questions. One is, what does this do to the commodities universe? Do you reckon that there could be weakness and until the resolution of this comes about?
Well, of course, because slower growth would put downward pressure on commodities. We were seeing a general rise in copper prices, and copper is such an important component of manufacturing across the board. And this should, hurt base metals, copper, other manufacturing imports. It's important to realize that not all categories of goods were subject to tariffs, anti-China tariffs, back in last year. And then there was the so-called truce in December. The kinds of products that would be within this new $250 billion threat includes things that U.S. consumers love, like cell phones and electronic gadgets. And this could have some backlash with consumers.
Okay. Said the other thing, when this whole trade war started, a lot of global guests were saying that India might actually benefit as a market and as an economy if indeed this happens, because it is in a sweet spot, doesn't get impacted too much, etc., etc. What happens in the period if this indeed snowballs into something bigger for the Indian markets?
Well, I think in general, the sentiment towards India is positive. And that has, frankly, less to do with India, and as you've touched on, more to do with negative China sentiment. The problem is that to date, India is really not a big net exporter. The government has done a good job, I think, promoting this idea of made in India And, we have delegations here. I would say that the Indian government ministries are fairly aggressive in having road shows and coming to the United States to try to support Indian exports. But it's still, other than services, there's not a lot of exports from India. So there's a big future there, but I think it's going to have to continue to be sold.
Okay, Seth, so before we thank you, until we hear the end piece of this, which may be some time away, do you think financial markets would continue to drift downwards from where they are right now?
I don't think that it will be a long-term trend. I think there'll be a reaction to these tweets, a reaction to how it plays out with China. But I don't think this sort of problem is going to have a long-term effect on the markets. But I think what's more important mid to long-term is just simply growth. And if global growth slows, yes, we're going to see some pressure on markets. On the other hand, we're seeing, record prices here in the U.S. stocks, and that does put pressure on emerging market stocks.